Hey there, Kris McCullough here. Ever get the feeling that somewhere in a tall, shiny building, there's a guy in a suit who just decides your mortgage rate on a whim? Maybe he spins a big wheel or throws a dart at a board. It can feel that way, right? One day you see a rate online, the next day it's totally different. It's enough to make your head spin. But I'm here to tell you, it's not some random game of chance. The truth is, your mortgage rate is set by a mix of huge, global economic forces and the details sitting right there in your personal financial file. It's a little bit of Wall Street and a little bit of your street. Think of it like the weather. No single person controls if it's going to rain. Forecasters look at jet streams and pressure fronts to make a prediction. But whether you get soaked depends on your umbrella. Mortgage rates are similar. All right. Let's start with the absolute basics. What exactly is a mortgage rate? It's the price you pay to borrow money for a home. Think of it as the rental fee for money. The bank or lender gives you a huge pile of cash to buy a house, and in return, you pay it back over time with a little extra on top. That extra is the interest. The mortgage rate is the percentage that determines how much interest you pay each year. It's the single most important number in your loan, because it impacts your monthly payment and total cost over the long haul. Borrow $300K at 6% versus 7%, and over 30 years that 1% can mean tens of thousands of dollars. So where do these rates actually come from? Mortgage rates are closely tied to the bond market, specifically to mortgage-backed securities, or MBS. When a lender like me gives you a loan, we don't usually keep it. We sell it to giant players in housing finance. Freddie Mac, Fannie Mae. They bundle thousands of mortgages into a big basket, an MBS. Your mortgage is one apple in the basket. Those baskets are sold to investors worldwide, pension funds, banks, asset managers. They like the steady income from monthly payments. When MBS prices go up, mortgage rates tend to go down, and vice versa. What about the Federal Reserve? The Fed. You hear them on the news all the time. Many people think the Fed sets mortgage rates, but they don't, not directly. The Fed controls a short-term rate banks use overnight. Mortgage rates usually follow the 10-year Treasury yield, a long-term benchmark. If you've started shopping for a mortgage, you might notice yesterday's quote isn't today's quote. Normal. Rates can change every day. On big economic news days, they can change multiple times. Lenders start with a morning rate sheet and can reprice midday if markets move. The big movers: inflation data, jobs reports, and economic growth. That's why locking matters. It holds your rate for a set time while you close. With the internet at our fingertips, you can find a rate in seconds. But many ads are best-case teasers. First, Freddie Mac's Primary Mortgage Market Survey. Weekly national averages every Thursday. Great trend benchmark. Next, bank rate. Aggregates average rates nationwide and updates more frequently. Finally, Mortgage News Daily. Daily rate index and why markets moved. Use PMMS for weekly trend, bank rate for daily averages, MND for the deep dive. Remember, these are averages. Your actual rate depends on your profile. The national average is just a starting point. Lenders adjust based on your specific financial profile. First and foremost, your credit score. Higher score, better rate. Think 740 and above for top-tier pricing. Lower scores mean higher risk, and usually a higher rate. Even 20 points can move your rate. Next, your down payment. Bigger down payment lowers your LTV, which is less risky for lenders. At 20% down, you can also avoid PMI. Double win. Loan type matters. Conventional, FHA, VA all priced differently. 15-year loans typically have lower rates than 30-year. Primary homes price better than second homes or investments. Debt to income matters. Lower DTI or stronger file. And points. Pay a bit more upfront to lower the rate or vice versa. Now for the million-dollar question, how do you get the best rate? It's not about perfect timing. It's about preparation. Pull your credit from all three bureaus, fix errors, then improve. Pay on time. Keep balances low. High utilization cards? pay them down. Avoid opening new accounts pre-approval. Save early and check for down payment assistance in your state or county. Get official loan estimates from at least 3 lenders. Compare rate, payment, and fees. Don't be shy. It's your money. Work with an expert to lock strategically. Don't chase headlines, chase preparation. It's easy to get caught up in the news cycle. Headlines shout, your heart sinks or races. Ignore the noise. You can't control the economy, but you can control your readiness. There's no perfect rate moment. The right time is when it fits your life and budget. As the saying goes, don't try to time the market. Focus on your time in the market. We've covered a lot, from global markets to your credit report. Rates aren't a mystery. Big economy sets the stage, your profile sets your price. Understand both, and you take the power back. Pay on time, save more, shop smart. Preparation beats panic. As a retired Marine, I believe in mission readiness, and home buying is a major mission. I'm Kris McCullough, retired Marine, loan officer, and owner of the KDM team. We're known for funding loans other lenders fear. We help home buyers fund homes and build dreams across multiple states. Find me on Facebook, YouTube, and Instagram, or visit krismccullough.com for more.